All right, welcome everyone. Welcome to this week's Sunday macro wrap-up for Sunday, September 14th. This episode is going to be a little bit more of a quicker episode only because, there wasn't too much macro data last week. Obviously, last week was a pretty crazy data. Let's see. Can you guys hear me now? Gotcha. Great. Yeah, as we know, last week was a pretty heavy week in terms of a lot of political strife. And so, in terms of the data, though, this week, we'll see what happens as we have on Wednesday. We have the Fed meeting, the September FOMC press conference. That is on Wednesday at 2 p.m. or at 2:30 p.m. Eastern time. I'll be going live for that. So make sure you guys are tuning in. We're going to be doing a live reaction to the Fed meeting. As well as translating all of the bank talk that the Fed, usually, uses whenever they do those press conferences. And so the interesting thing that's happening right now is that, with inflation continuing to accelerate with the Fed cutting rates, this is just a prime time environment for risk assets to continue climbing higher. And so we'll get into all that here momentarily. Just taking a look at some of the data last week, we had producer prices go down 1 month. As we know, the August PPI print scared a lot of the market, saying that, inflation was going to reaccelerate, which it came back down on the producer price end, right? So these are prices that the input prices that producers pay. But the inflation rate that we care about really is the consumer prices. And as we see, that rose to 2.9% year over year, and this is up from 2.3% in April of 2025 this year. So quite an acceleration over the past 4 months, and we see that continuing higher here. When we take a look at core inflation, that remained at 3.1%. So core inflation that removes volatile items like food and energy, that remains highly elevated. And so, this is nowhere near the Fed's 2% goal. And it seems that they are trying to, ditch their 2% goal in order to preserve the labor market, as well as possibly succumb to the administration's needs for reducing their debt burden on interest payments. And that's a dangerous environment, right? Fiscal dominance is what that is called. And typically when you have the federal government, bullying around a central bank and their policy, that's typically when you get into some sticky scenarios, for the government in question. Interestingly, too, we had a pretty large acceleration in initial jobless claims last week. So 263,000. That was the largest since, let's see here, if we go back. Yeah, so this was pretty much the largest spike, since 2021, really. So pretty large acceleration in initial jobless claims, which is obviously not a great sign for the labor market, which is what's in focus. But also keep in mind, we also see that the housing affordability index is at record lows, while at the same time, the median sales price for homes continues to remain, elevated. And so, we're in a strange environment right now where home prices remain elevated, although in some parts of the country, like where I live in South Florida, we are seeing prices start to come down a little bit. But what's going to happen to home prices if you have the Fed cutting interest rates, with them remaining higher, right? They're going to start to spike up even more. So I'm not sure if, the Fed cutting interest rates with home prices remaining high like this, I don't know how that's going to positively affect the home affordability index. if anything, it would cause home affordability to remain low here. So we'll see what happens there. But it will, having rates lowered will spur some economic activity within the housing market for sure, at least with people who want to refinance their mortgages. And so, really, there's only 4 days of the week that have big macro data releases. On Monday, tomorrow, it's the Empire State Manufacturing Index. So that's one of the largest manufacturing indices for the New York area. And then we have retail sales numbers on Tuesday morning. That's one of the best leading indicators for consumption, right? And as we know, consumption makes up nearly 60% of the entire GDP number. So that retail sales number is pretty important. And then we get some other housing data like building permits, housing starts on Wednesday. And then later that day, we have the Fed meeting. On Thursday, we have the Philly Fed Manufacturing Index, as well as the Conference Board's leading economic index. So there's a few things, but really the main thing, the main two things are core retail sales, as well as the FOMC press conference here. Hold on a second. Getting over a little bit of a cold as well this week, so forgive me there. But the Fed is expected to cut by 25 basis points at this meeting. And then throughout the entire year, they have right now, let's see, the market is pricing in, let's see here, so for watch. So right now the futures market is pricing in 3 rate cuts from now until the end of the year, which is a 25 basis point cut each meeting from now until the end of the year here. So yeah, I mean, that's a continuation of the pause from last year's rate cutting regime. So yeah, this is really interesting having the Fed cut rates with accelerating inflation. That's really the main thing that I want to hear from this week's FOMC press conference is what are they going to say about inflation? Are they going to continue to push their thought process of, oh, this is just a one-off acceleration with inflation. After that, it's going to start coming down. That's really what we want to hear the Fed talk about is what their expectations are with inflation and then where it goes from here, right? Because from what I've seen over the past couple years is that when the Fed's credibility gets negatively impacted from them trying to, when they give forward guidance during these press conferences and the market or the incoming data reacts in the opposite way, that's really when you start to see some of those stark corrections, even though, they're ultimately corrections after or right before it goes even higher. But you really need to see those credibility dynamics with what we get with the real data versus what they are guiding. But taking a look at the markets here, one of the main tickers that I'm paying attention to is the 5-year break-even inflation rate, which, as we've highlighted before, this time last year when they were set to cut interest rates, the 5-year break-even was around 1.9%. And now a whole year later, it's up 50 basis points. And so they're cutting interest rates at a much higher inflation expectation target for the 5-year break-even. And with that, they're playing with fire here. And so in the immediate term, you can continue to see this being priced into the market with, indexes going higher. Because again, stocks, risk on assets, they do well when, you're having a dollar devaluation or there's future growth and inflation expectations rising. And so that's really what we're seeing right here. But it's being mainly driven by crazy government spending, as well as now with the Fed cutting interest rates, you're getting it from the central bank side as well. When it comes to the yield curve, right? So over the past week, we've seen a large decline in the 10-year U.S. government bond yield, breaking through that 4.2 number that it's really been holding, ever since this time last year. So that was a big mark. It actually did break it briefly during the beginning of April crash that we saw, and then it quickly reverted there. But, I wouldn't be surprised if we did have a little bit of a pop up in yields this week, considering we did have a large deceleration last week and yields are near the low of the trading range. Still bearish trend though, but I wouldn't be surprised if we did have a a little bit of a pop up here in rates. And so if that happens, we'll see. This could be a sell the news event with the rate cuts, because as of right now, it seems like we're hitting peak dovishness, right? So we might be getting some data from here that causes the market to, just have a reversal of what we've been seeing. But with that, we continue to see volatility levels remaining very low, below 15. Taking a look at the volatility index of the S&P 500, below 15, as well as if we take a look at credit spreads, that those remain in a bearish trend as well, if I can find it. Yeah, here we go. So credit spreads remain at historical lows, meaning that this is really a risk-on environment. You saw credit spreads spike during the bearishness that we saw earlier this year, but since then it has remained back in bearish trend, which, like I mentioned before, is really a bullish signal. And so all this to say is that I wouldn't be, over the past few weeks, the retail sentiment indexes have been very bearish with the market, even though it's been making new all-time highs every single week. So I would still not be betting against this market. I think we can continue to see it grind higher. That, as well as we could start to see a little bit of a correction on gold if we start to see bond yields move off of their low of the trading ranges, which would potentially get a re-steepening of the yield curve, which, over the past, week or month, we've seen a little bit of a flattening here. If we do see it steepen again, we might see gold come back down, which would provide a pretty good buying opportunity for gold there. Silver continues higher. Silver typically doesn't do this unless it expects inflation or growth to rebound, which is interesting. Same with other base metals, right? Platinum, palladium. Both of those had very large rebounds over the past couple weeks here. Base metals usually don't do that if it's not expecting inflation or growth to have a little bit of rebound. What is interesting though is that Bitcoin did go back to neutral in our model. It broke through that 114 level to make a lower high here near the top end of the trading range. So I would probably wait for Bitcoin to see how it's able to retest maybe the 112K level. So we'll see that there. Same thing with Ethereum. Ethereum looks like, it could possibly have a retest here. We were buying that on the dip here, which had a nice little pop last week. Same thing with Bitcoin miners. I mean, at this point, we've been talking about Bitcoin miners for the past 3 months. If you haven't been getting in on this move, I mean, this has just been amazing. Some of the single stocks that are within this Bitcoin mining ETF have been doing pretty well, like IREN. That has been up, I think it doubled actually in the past 3 months. So a lot of those have been doing well. China has been doing well as well. And then when we take a look at the S&P 500 here, I'll go to the SPY. We'll take a look at the ranges heading into this week. And as you can see, it closed last Friday near the top end of the trading range, which for our group, it's typically signaling a great sell signal in order to buy lower. So again, seeing that bond yields are at the low of the trading range. We have gold and the S&P 500 both at the top ends of their trading ranges. If we do, heading into this event this week, which is the FOMC, I wouldn't be surprised if we get a little bit of a reversal of that move, which would provide another buying opportunity. So the whole thing last week was, raising cash on winners in order to buy lower. And so that's what we're going to do. Lots of the Mag 7 stocks remain in a clear bull trend. The most recent one being Berkshire, which was in a bear trend for a few months here, and then it just went back to bullish trend at the end of August there. Tesla had a pretty big breakout, breaking through its top end of the trading range. This went bullish in our model, I believe, right here. This is when it broke through and closed above that $339 level. And then it had a nice little retracement for a buying opportunity, making another higher low. And then it's ever since then, it's just been making a series of lower lows and higher highs with this final breakout here. And so, yeah, the signal caught Tesla as well. But yeah, I mean, I don't know why people are trying to short this market. It doesn't look like it's slowing down anytime soon. One of the main ratios that I like to look at is the consumer discretionary versus consumer staples ratio. That clearly remains in a bullish trend and is showing that we are right back to, peak bullishness that we saw at the end of February of this year. So, really, if this starts to break down at all, then I'll start thinking about, potentially, waiting and see what happens with the major indices, but this is not slowing down at all. So again, just being cautious about being overly bearish. This is not the environment that you want to do that, at least in the short term, right? Maybe in a few months from now or heading well into 2026, that might change. But as of right now, this is a great, short-term profit-taking opportunity, but definitely, not wanting to short it. That's for sure. And then one thing that I'm noticing is net central bank liquidity continues to come down here. So net central bank liquidity is declining, which could possibly be why Bitcoin is facing some headwinds right now. And then the main reason is because the Treasury is trying to refill the Treasury general accounts up to that $850 billion level. And so that's another nearly $200 billion that's going to be leaving liquidity in the financial markets. So that could potentially be continued headwinds for things like Bitcoin that are super sensitive to liquidity. But yeah, I mean, that's pretty much all I have for you guys here. For those who are watching us live on our streams, for those who don't know, for these Sunday macro wrap-ups, we typically do the first 30 minutes live streamed, and then after that we do the remainder of the 30 minutes to 45 minutes only for our macro optics members. And so if you guys want to be a part of that discussion where we talk about actionable ideas and some other tickers that we're looking at, I would highly recommend you check out our 7-day free trial of our macro investing community. Just use the link below there. But for those who are on the Zoom call here, just stick around. I'm going to go ahead and log off of all of the streams, and then we'll get into some of the ideas there. So one moment. But for now, we'll go ahead and say bye to YouTube's.